Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again John Rubino. And you should be sure to go to dollarcollapse.com to keep up with John's work, as well as the works of other authors who write there. A lot of really good stuff there, dollarcollapse.com. John has authored quite a few books, actually. I suppose the one that's best known might be The Collapse of the Dollar, that he and James Turk co-authored, and a more recent one, The Money Bubble, What to Do When It Collapses, also co-authored by John Rubino and James Turk. Both very much worth your reading, and also dollarcollapse.com. Go there, very much worth your time to get John's latest take on various markets. Thanks for joining me again, John.
Hi, Jay. Thanks for having me back on.
Always good to have you with me. We've titled today's show, or at least the idea of today's show is, what impact, if any, will Brexit have on the price of gold? First of all, I hear there's a lot of people suggesting that maybe Brexit won't even happen, that in fact there could be a veto that comes out of Scotland, or there could be that it's non-binding, and therefore the politicians don't really have to pay attention to what the British people want. Do you think Brexit is going to happen?
Well, I think Britain leaves the front pages pretty soon here, because now comes 2 years of basically grunt work, right? First, they have to figure out who's in charge of the different political parties, because both David Cameron and Jeremy Corbyn of the Labour Party are out, apparently. And so the next few months will be kind of internal electioneering, where they try to figure out who's going to run the country. And that's not really very important to the average American or to the financial markets. And then they got to negotiate with the EU over the terms of Brexit, should they go ahead with it. And that's not going to be that interesting either, because it's going to take a really long time to knock out, the details of trade deals and stuff like that. So Brexit, I think, is over as a big story. But what it represents is very interesting, because it's the first domino to fall in what might be several, maybe more than several dominoes. Because now that the other anti-EU, anti-Euro, anti-austerity political parties out there see that it's possible to strike a blow against the European Union, you're going to see similar kinds of movements spring up in other countries, and they're going to be energized by Britain's success. National Front in France, for instance, is headed by Marine Le Pen, who is now the most popular individual politician in France and is anti-Euro and anti-European Union. So let her win the next presidency in France, and we'll see a Brexit-style movement in France, except it'll be called Frexit. And that will throw the global financial markets into an absolute tizzy, because France is central to the biggest economic bloc in the world. And, Britain can leave because they were always peripheral, so they're not a mortal threat to the European Union. But let France try to leave, and it's game over. And it also, flowing from Brexit, is really a mass devaluation. You can't hold the Eurozone together with it being as strong as it is, because Italy and Spain and Portugal and Greece can't function in a strong currency environment. So if the Eurozone wants to maintain the common currency, they're going to have to devalue and push interest rates down to even lower levels, even more negative levels. And that, in turn, is devastating for the big banks, because they already can't function in a zero interest rate / negative interest rate environment. The banks are the big problem industry out there now. Other than oil, the banks are probably the most seriously impaired business model that exists in the world today, the big banks. And, Deutsche Bank especially is a catastrophe waiting to happen. They're like the Lehman Brothers and Bear Stearns rolled into one right now. They've got a derivatives book that is several times the size of the entire German economy. Their stock price is down by 2/3. They're reporting massive losses, and there's no end in sight, because interest rates are not going up. They're going down. And the lower interest rates go, the more of a problem that is for big banks. So I think the process that Brexit was a part of was already in progress. It was already happening, but Brexit turbocharged it. And now we're going to see chaos in the European Union, which bleeds over into Japan, for instance, because as the euro and the pound go down, that's the same thing as saying the yen is going up. And they're desperately trying to to devalue the yen, but they're failing. And the yen keeps getting stronger, which is going to, first of all, make their massive debt load even harder to manage. And second of all, impair their exporting industries, which is basically all Japan has going for it. So, yeah, everywhere you look, things flowing out of Brexit are threatening other parts of the global financial system.
So Japan's currency getting stronger is hurting its export business, I guess, huh? Because it's relative to the euro. The euro's getting weaker, forcing Japan's yen higher relatively.
Yeah. Currency valuations, when you say, the yen is strong and the pound is weak, what you're really talking about is relative to each other. There is no objective measurement of currencies out there in a fiat currency world. So if one goes down, another one has to go up by definition. And it's the yen that is now going up. And Japan, it might be the country least able to handle a rising currency. So they're also, like Deutsche Bank and like the European Union in general, Japan is a time bomb, and the fuse is lit. And the coming year, we'll probably see one of these things blow up. It might be Deutsche Bank, it might be the Eurozone spin out of control, it might be Japan having a currency/debt crisis. There's no way to know who's going to be first. But those things, when they happen, will be bigger than Brexit. And, already Friday was the biggest single-day loss of equity market value in history. We lost $2 trillion of wealth that just evaporated that day. Mm-hmm. And there's no reason to think that something much, much bigger than that isn't on the horizon imminently.
Oh, well, that's a very frightening thought, because all manner of chaos can break loose from that if countries go broke and banks can't pay, and you can't get money out of your out of the machines at the bank. What happens, John? You start to have utter chaos
utter chaos.
It's very frightening in a way when you think about it. But yeah, I wanted to ask you. So the winners and the losers. I mean, you can, I guess, speculate, and well, more than speculate. You're seeing what's happened already to Japan. The U.S. dollar's gotten stronger as a result in the last few days since Brexit. But as you say, Japan probably less able to handle a stronger currency than the U.S. is. But so and then corporately, you're noting. In fact, you put out a very good piece. I think it was today or yesterday, perhaps. You were talking about comparing the precious metals miners to the banks. The banks' share prices have just really tanked since Brexit. I guess that's the time frame that you're looking at, or was it longer? I'm not sure. I just saw your piece. The bankers are the big loser, the big segment loser in this thing, as you see it?
Yeah. Well, the chart I put up was just for one day. It was Friday, with the banks just getting crushed. I put up a chart of the stock prices of major banks.
Yeah, I'm looking at it.
Are down double digits. 14, 16, 18% in one day. Yeah, that's gigantic for something as big and stolid as Credit Suisse or Deutsche Bank. Those kind of moves almost never happen, nor should they ever happen.
Yeah. John, I'm looking at your chart now. Credit Suisse lost 14.87%, Deutsche Bank 16.32%, BNP 16.75%. I mean, that's just astounding.
In one day. Actually, that was intraday. It might have been worse by the end of the day.
Yeah. Well, it's amazing. And then, of course, by contrast, we see the gold shares went up very dramatically, the majors at least on that day. So this is really very interesting. I noticed in terms of gold, on Bloomberg there was a report that the Chinese investors rushed out on Friday to buy huge amounts of a gold-backed ETF there. It jumped 191 million last Friday. So Chinese are buying a gold ETF. Do you have any sense of whether this is just paper gold or is it real gold? And I mean, with respect to our own ETFs, even our own gold ETFs, I know your colleague James Turk has written some things in the past questioning the legitimacy, or let's say the reality of gold ETFs actually owning and holding the gold. But do you have a sense as to whether that means that gold, actual physical gold, is being taken off the markets? Do you think that that's the case, or is it just people buying virtual gold, as many Americans seem to think if they buy their ETF or whatever, that they're actually owning gold itself?
Well, it's probably both. The Chinese like their physical gold, culturally. And the government has been buying 1,000 tons a year or so for a decade now. And they have an awful lot of gold, much more than they're admitting to right now. And they've been encouraging their citizens to do the same. So China is a big buyer of physical gold. And these ETFs, they vary in quality and in covenants. And some of them, like GLD, for instance, the big one in the U.S., is a trading vehicle, but it's not a way to actually own gold because, according to their rules, they don't necessarily have to have all the gold that they would need to cash out everybody who wanted to cash out. If everybody took their shares and tried to convert it to gold, there's not that much gold in their vaults. So that is a trading vehicle. If you want to bet on gold going up this week, that's a really simple, convenient way to do it. But if you want to own gold for the next 10 years as a way of preserving purchasing power, that's not your vehicle. There are other funds out there, and I don't want to name names because I am not an expert in the details of every single fund and don't want to leave one out or mistakenly put one in one category when it belongs in another. But there are some that are set up a lot more legitimately as far as allocating your gold to you goes. And so those are reasonably good proxies for physical gold, but there's no real substitute for actually owning the stuff and having it in hand. That's the core of your portfolio. If you want something that is absolutely guaranteed to be yours going forward, then you got to own it yourself, and the next step beyond that is to have it be stored for you in a super safe, insured vault by somebody who's got a legitimate history of doing that for customers. And, James Turk's Gold Money Company was designed to do that a decade ago and has done a good job since then. So the mining stocks are a separate thing, and they're the things that have gone up most lately. The gold has gone up a few $100 an ounce. Some of the mining stocks have quadrupled in that time. And the reason for that is this, and by the way, Jay, I'm sure your listeners know that you are one of the world's experts on this subject. So I'll just speak briefly.
Well, thank you. That's very kind of you. I don't know how, I work hard at it, Jay. I work really hard at it, and we look at the fundamentals of exploration companies. And I would say that the most exciting stories, the ones that gain the most percentage-wise, are the small exploration companies that are successful in their exploration efforts. So my area of expertise is more in trying to find the explorers that can be successful. And in down markets, there's no money at all for those companies, and they basically go into hibernation, and the share prices, there's no liquidity. We've come out of that. There's no liquidity, but when there is, and when they start to find some and start to build up a resource, then these share prices can rise very, very dramatically. I was just talking to Aron Resources, which I think is one of the best out there. But one thing I'd like to ask you about, John, is that during the 1930s, when we had the depression of the 1930s, and gold was confiscated. I mean, we can ask you whether you think that's a possibility again, and I'd like to get your thoughts on that. But during the 1930s, when gold was confiscated, of course, the miners were allowed to continue to operate. In Homestake, for example, it went up several fold. I can't remember exactly how much. While the stock market lost 90% in its worst time, the Dow, the gold shares went up 4 or 5 fold, something like that. You think that's a possibility in the future, that we might see a confiscation or a requirement for turning in gold? Because you mentioned China and Russia, I know, is building up their gold reserves tremendously. They're building the new Silk Road. They're consolidating their own trading environment, their own economy over there, in part because the United States is freezing them out and trying to compete with them in Asia and so forth. But does the United States have the gold is one thing. If the United States was forced to shore up its currency and restore confidence in the currency with some sort of a gold or silver backing, would the U.S. have the gold is the first question. And secondly, where has China gotten all their gold from? I know they're the largest the largest producer of gold right now, and Russia's not too shabby either. But any thoughts along those lines? I mean, as you point out, owning the gold shares is quite different than owning the gold bullion. I think you need to own the gold bullion personally, first and foremost, and then speculate with the gold shares.
Yeah, gold bullion, in other words, gold and silver coins for an individual, that's your cash, okay? That's the thing that you don't expect to go up necessarily, but you expect it to hold its value. Gold mining stocks are your investments. Those are the things that can not just hold their value, but go up 2, 3, 4, 10 times in a lot of cases. So they can make you lots of money. And you combine those two, and if gold goes up versus dollars and euros and yen, you do very well. You know, your portfolio succeeds where a lot of others fail. Now, as for where China is getting its gold, that's a big, interesting point of debate in the precious metals community, because the world doesn't produce enough gold, the world's gold mines, to satisfy China, Russia, and India each year. They're getting more gold than is produced by the world's gold mines. So it must be coming from somewhere. And speculation is that it's some of the big Western central banks shipping their gold to Switzerland, who then melt it down and reform it into bars that are of the size that the Eastern buyers like, and shipping it to Hong Kong or Shanghai or wherever. And so it's not clear which Western central bank is tapped out, or if they're all equally, dipping into their vaults and shipping gold east. But it's coming from some central bank in the West, and the British central bank, the Bank of England, is one of the prime possibilities. And we don't know what the U.S. is doing, but we've got, in theory, the most of anybody. So we could most easily satisfy Chinese demand. But still, there's a limit. We don't have infinite gold.
Yeah, there really is a limit. And unfortunately, there's a limit on our time. My engineer is telling me only 1 minute left to go. John, just one quick question, and I need a quick answer. Is Brexit deflationary or inflationary?
Well, it's probably both, because if it causes a debt crisis, that's deflationary. If it causes everybody to devalue their currencies, that's inflationary. And just like, today's world pre-Brexit, we got these two big forces out there contending, debt deflation versus monetary inflation. And it's not clear who wins.
All right, we're going to have to leave it go at that, John. Unfortunately, we are going to talk about next week to Ron Paul, who I know is the ultimate inflationist. He believes it will end that way. Sorry to cut you off. I know there was so much more to talk to you about. We'll have you back again sometime real soon.